Heya Cryptozens, welcome back to the Crypto Overnighter. My name is Nikodemus and we do crypto news analysis nightly at 10 p.m. And keep in mind, none of this should be considered financial advice.
And it's Tuesday, March 21st, 2023. And welcome to spring here in the Northern Hemisphere, and I am ready for it. On Monday, Governor Ron DeSantis of Florida announced a proposed bill. This bill would prohibit the use of central bank digital currencies in the state of Florida. DeSantis is known for his support of cryptocurrency, so I'm not surprised to hear DeSantis argue that this proposal is necessary to counter the Biden administration, specifically their alleged weaponization of the financial sector through CBDCs. DeSantis argues that the issuance of a CBDC would enable surveillance and control and would hinder innovation. According to him, the Biden administration's efforts to introduce a central bank digital currency poses a threat to personal economic freedom and security. Now, DeSantis aims to protect Florida customers and businesses from adopting such policies and will not side with the economic central planners. In addition, the press release connects the introduction of a CBDC to a potential way for, quote, woke ideology like environmental, social, and governance to infiltrate the financial sector. He also encourages other states to consider banning the use of a CBDC within their own borders. In the past, DeSantis has shown support for broader adoption of cryptocurrencies. For instance, in August of 2022, Florida permitted businesses to pay their state taxes with digital assets. As the development of CBDCs progresses, there has been growing opposition to their implementation. Florida's governor is not the only one who has expressed concerns about the potential for government surveillance with the introduction of a CBDC. In Europe, there was a similar debate back in April, and the European Central Bank confirmed that a digital euro would not provide the same anonymity as physical cash. More recently, a UK advocacy group launched a campaign against the digital pound, stating that would be an unprecedented incursion by tax authorities. The group, called the Tax Reform Council, warned that implementing a digital pound could allow the government to easily track all transactions in a centralized ledger and could compromise public oversight of the authorities. Now, despite the growing opposition to CBDCs, many countries have started working on their own central bank digital currencies. All of the G7 and 18 of the G20 economies are currently in the development stage. Now, according to a source at CoinDesk, the Central Bank of India is pushing for a new law. This new law would let users of its central bank digital currency have access to a delete button. That's right. That would mean central bank digital currency transactions could happen, and then proof of it could be erased. They say that this move aims to help people stay anonymous while using the currency. Now, currently, the Reserve Bank of India is conducting tests of both retail and wholesale versions of their central bank digital currencies. The retail version is already in use in 15 different cities. The source reported that over 100,000 customers and 13 banks are taking part in India's central bank digital currency pilot. However, for the Reserve Bank of India to include the delete option in the central bank digital currency, the country's finance minister may have to pass new laws through Parliament. These laws would give the RBI the legal authority it needs to implement the deletion feature. That source stated that India's central bank is focused on preserving privacy in its CBDC. They are requesting that the government pass legislation to permit users to delete transactions and to stay anonymous if desired. And a lack of anonymity is an issue. CBDCs have raised concerns worldwide, with lawmakers and individuals worried about potential surveillance. And as we just talked about with DeSantis proposing laws to ban central bank digital currencies altogether because of those privacy concerns. Now, a source confirmed that India's push for privacy in its CBDC may be the first such effort by any country. India has also announced plans to work with the UAE to conduct joint pilot programs on CBDCs, and the country is looking to establish more bilateral partnerships in this area. So think about what they're asking for. They're asking for a way to delete data from the official roster of transactions on your account. And if it's a choice, pretty much everybody's going to opt in for it, right? Once the possibility exists, that is. And if you can delete the data, that means it's possible for the government to delete that data too. which in fact is what you would be doing. You wouldn't be deleting anything because the government controls their ledger. So you would be asking the government to delete sensitive information on your behalf. I just don't see that going well. Now, according to a story by the International Monetary Fund, a central bank digital currency can unintentionally affect monetary policy. It can increase money velocity. It can disintermediate, alter capital flows and currency substitution, and create volatility in bank reserves. The unintended effects of a central bank digital currency can be especially significant in the Islamic banking system. This is important because the Islamic banking system is present in 34 countries. It's systemically important in 15 of them. That said, the Islamic financial system accounts for less than 2% of global finance, and only Iran and Sudan have fully Islamic banking systems. However, 10 countries with an Islamic financial presence, including Iran, are currently considering central bank digital currencies. So the design of a central bank digital currency is already complex, and it's going to be even more complex due to Islamic law's prohibition of usury and speculation. This prohibition strongly affects liquidity management. Now, traditional methods of liquidity management include interbank market, secondary market financial instruments, central bank discount window, and lender of last resort. Now, these rely on interest, and so they're not allowed for Islamic banks. Additionally, the prohibition on speculation means that CBDCs cannot be utilized for foreign exchange derivatives transactions. Moreover, Islamic liquidity management instruments are slowly developing due to unsupportive regulations, Sharia compliance complexities, limited standardization, the small number of Islamic banks, and the underdeveloped financial sectors in many countries. Because many countries lack the infrastructure for Islamic banking. This has led to an excess of cash held by Islamic banks. Since deposits in Islamic finance banks don't pay interest, nor would religiously compliant CBDCs pay interest, this means the risk of bank disintermediation increases, according to the study. Now, the response to cryptocurrency in the Islamic world has been mixed. While some countries in the Middle East and North Africa region have rapidly adopted crypto, others have not. Islamic scholars have varying opinions on cryptocurrency as well. For example, the Securities Commission Malaysia Sharia Advisory Council deemed crypto trading permissible, but Indonesia's National Ulama Council disagreed. Now, moreover, business interests in Iran have advocated for the use of crypto in foreign trade. On Tuesday, the U.S. Supreme Court heard arguments about a case related to crypto. Now, I believe this is the first trip to the Supreme Court for cryptocurrency, although we'll see that it's really not about crypto anyway. Lawyers from Coinbase will try to persuade the 9 justices to stop a couple of class action lawsuits against the company. And like I said, the case really isn't about crypto. It's about whether a lawsuit can continue in federal court when one party, like Coinbase, is trying to move the case to arbitration. So it's more about the process of lawsuits than crypto specifically. So here's what's up. Coinbase is challenging a previous ruling made by a federal court in California. That ruling permitted 2 lawsuits to proceed, Bielski versus Coinbase and Suski versus Coinbase. Now, Coinbase's user agreement requires disputes to be resolved through arbitration. Now, arbitration is an out-of-court method of dispute resolution. The salient point here is that some perceive arbitration as being unfair to consumers. Now, last April, the U.S. District Court for the Northern District of California denied Coinbase's motion to send the Bielski case to arbitration. The court deemed Coinbase's arbitration clause unconscionable. They said that it was designed to disadvantage their users, and Coinbase appealed to the 9th U.S. Circuit Court of Appeals in July, at which point the decision was upheld. Now, Coinbase has faced multiple class action lawsuits, and some have been dismissed by judges, while others have been allowed to advance. The lawsuits have dealt with various issues, such as claims that Coinbase sold unregistered securities, or that they mishandled their public listing, or had inadequate security measures leading to hacks. One such lawsuit, brought by Bielski, accused Coinbase of breaking the law by not reimbursing him for losses over $31,000. Reportedly, these losses were due to a scammer pretending to be a PayPal representative. The second case is Suski versus Coinbase. This case centers around a $1 million sweepstake event held by the exchange in June of 2021. Suski and other customers alleged that they were misled by advertising that implied they needed to trade $100 worth of Dogecoin to enter the sweepstakes, when in fact, even those who didn't buy or didn't sell Dogecoin, they were still eligible. Now, I have to be honest. I remember that sweepstakes, and I thought you had to trade $100 worth of Dogecoin in order to qualify. I don't really do those kind of contests, so I never really looked into it, but I thought you had to trade $100 worth of Dogecoin in order to qualify. Now, as Coinbase faces an increasing number of lawsuits, it's struggling to keep up. If the Supreme Court rules in Coinbase's favor, future suits may be sent directly to arbitration, which would certainly make things easier for Coinbase to handle. Now, this case is not gonna set precedent for major crypto issues. It will certainly have implications for other crypto companies facing class action lawsuits. The case is the second on the docket, and oral arguments will last for about an hour. The case is scheduled to be heard at 10 a.m. Eastern. Circle's CEO, Jeremy Allaire, expressed excitement about their growth strategy in Europe with their latest application. And when I say application here, I mean their licensure application. I don't mean that they're putting out a new app. Now, he cited France's progressive approach to crypto regulation. This application requires companies to undergo checks on governance and money laundering protocols to be able to serve the French market. Successful registration will allow Circle to serve their customers in France. Circle plans to ensure that their euro-backed stablecoin is compliant with the EU's markets in crypto assets regulation. This regulation imposes limits on the trading of cryptocurrencies linked to foreign currencies like the US dollar and requires insurers to hold reserves. AXA investment managers, Binance, and Societe Generale have already registered under France's regulatory regime, which will become stricter starting January of next year. The European Parliament is expected to have a final debate on MiCA on April 18th. This will include an additional transitional provision for companies already registered with an EU member country. Now, we've talked about Nigeria a number of times of late. The citizens are not happy with their central bank digital currency, and the people are looking for a way out. As a result, crypto adoption in Nigeria is exploding, while Consensus has announced that MetaMask and MoonPay have broadened their partnership in Nigeria. This will allow MetaMask users to purchase crypto tokens directly from their wallets. The buying process is easy, and users can choose Nigeria as their region. They can pay using local bank transfers and select the MoonPay quote linked with their purchase amount. Finally, the tokens can be stored securely in their MetaMask wallets. To make it easier for Nigerians to buy crypto, Consensus has integrated with MoonPay. Now, MoonPay already offers localized peer-to-peer crypto purchases in Nigeria, and they partner with YellowCard. YellowCard is an African fintech outfit. Now, unfortunately, Nigerians do face challenges buying crypto due to a ban by the central bank on commercial banks servicing crypto exchanges. The removal of that fiat on-ramp makes it more difficult for citizens to buy crypto. Moreover, many Nigerian banks have suspended their debit cards for international transactions, which also makes it difficult for users to purchase crypto on centralized exchanges. Nigerians have resorted to peer-to-peer transactions due to restrictions on buying crypto. That exposes them to fraud and bank account closures by the central bank. MoonPay's chief product and strategy officer believes their integration will address this challenge. Crypto UK is a lobbying group, and they have requested that UK banks receive a list of registered crypto companies to prevent the sector from being excluded from the financial system. The group is worried that legitimate crypto firms will not be able to obtain bank access. Major lenders in the UK have expressed concerns about granting access to risky financial products for their customers' safety. This has led to worries about the exclusion of legitimate crypto companies. Crypto UK has urged the UK government to take action to avoid bans and restrictions on transfers from UK banks to crypto asset platforms. The group's Director of Operations sent a letter to Economic Secretary Andrew Griffith on Tuesday, calling on the government to find a way forward. Carpenter argued that such restrictions could undermine the government's ambition to become a crypto asset hub. Another letter was sent to two regulatory agencies, the Financial Conduct Authority and Payment Systems Regulator, urging them to take action. The Australian Prudential Regulation Authority has asked local banks to report on cryptocurrency transactions. This comes after the collapse of Silicon Valley Bank. The APRA is concerned about the exposure of Australian banks to startups and crypto-related companies. The request for reports have started, according to the Australian Financial Review, on March 21st. To gain better insights into banking exposures into crypto and its associated risks, the Australian Prudential Regulation Authority has ordered banks to improve their reporting on crypto assets. According to 3 anonymous sources, the regulator has directed banks to provide daily updates to the authority. The new measures are part of the authority's increased supervision of the banking sector following recent massive collapses in the banking system. Credit Suisse collapsed over the weekend, and UBS Group agreed to buy it for $3.2 billion, making it one of the latest banking industry failures, following the collapses of SVB and Silvergate. According to analyst Jonathan Mott, the situation for Australian banks is currently stable. Mott informed clients of this through a note, but he also warned that bank margins could be affected by a loss of confidence. Mott added that smaller institutions are not seeing any significant withdrawals of deposits and that their capital and liquidity buffers are strong based on their channel checks. However, he stressed that the crisis is one of confidence, and as a result, credit spreads and the cost of capital will continue to increase, which could put more pressure on bank margins. Additionally, Mott warned that credit quality will continue to deteriorate. Now, as we spoke last night, the Australian Banking Association has launched a cost of living inquiry to study how the COVID-19 pandemic and geopolitical tensions are affecting Australians. This news comes soon after an analysis revealed rising inflation and warned that over 186 banks in the US are at risk of a similar shutdown if depositors decide to withdraw all their funds at once. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, please like, follow, subscribe, leave a rating or a review. And in the meantime, we'll see you tomorrow night.